So before we get into your investment outlook, can you tell me about Investcorp? What's your assets under management and what is your investment strategy?
Sure. So we are a global diversified alternatives focused manager. Alternatives is all we do, and within alternatives, we are currently investing in private equity, direct investing, real estate, again, direct investing, absolute return strategies, which are mainly hedge funds, fund of hedge funds, special situations, and the likes of that. And of course, credit, which is a big part of our total AUM, which currently in the aggregate is about 23 billion in total, of which about 10 billion is in the credit strategies. And of the remaining 12 and change, roughly 5 in private equity, 2.5 in real estate, and the rest in absolute return investments.
So what has your portfolio looked like historically and what has changed over the last year or so?
So the portfolio historically has been very much focused on investing in the developed markets of United States, North America broadly speaking, but predominantly US and Western Europe, right? Over the last couple of years in particular, we have been progressively opening up our geographic focus. So adding to the US and European transatlantic focus, a much bigger, better developed capability into Asia, right? And Asia, again, is not a homogeneous market. There are pockets of Asia that we believe offer a much more attractive risk-reward opportunity relative to others. So the two markets we prioritized in Asia to start with were China and India. Both markets are such that you don't really want to be doing those from remote. So the first order of business for us was to try and find a market entry strategy where we could work with local partners or have a local team on board. In China, we partnered up with a very large Chinese asset manager on mainland China to do a portfolio of investments focused on China tech. We believe that space has a lot of secular tailwind to it, and to a large extent is somewhat immunized from the trade tensions that we are witnessing today between China and the US in particular. And in India, we are in the final stages of onboarding a team from another financial services firm. We are effectively acquiring a going concern platform focused on private equity and real estate. So in both cases, we've kind of hit the ground running. It gives us a great entry opportunity into these very large, fast-growing markets that are going to be increasingly more significant going forward in the future. So that's been one shift. And in terms of the transatlantic footprint, we've been investing in US real estate since the beginning. We are amongst the top 10 foreign institutional investors in US real estate for the last 10 years plus. But Europe was a new market for us. We started investing in Europe, real estate direct investing, about 3 years ago, and that business has ramped up quite nicely. We are focusing on UK. Obviously, Brexit has some overhang on it, so we are keeping a cautious eye on that. But we've done a lot in Germany recently, and now we're looking at the French-speaking countries as well, Benelux, France, and so on.
So in the US, does US real estate still look good to you?
It is, pockets of it, right? So it would be a little difficult for me to, kind of paint it all with the same common brush. But there are parts of US real estate that we really like, right? And those are backed again by long-term secular trends. See, one thing about Investcorp I should mention is we have the luxury almost of being able to take a long-term view and invest through the cycle, right? So we are not taking a quarterly earnings view. We are taking a 5-year, what is the fundamental value proposition of each business, each property that we can capture and grow, right? So in the US, the secular long-term view that we back quite strongly is one in the industrial logistics space. With the increased adoption of e-commerce, the shift away from high street retail into last mile distribution, servicing, delivery, etc., that is driving a lot of growth potential for that, distribution warehouses, logistics, etc., centers in urban hubs, like Minneapolis, like Chicago, down south near Austin, and so on and so forth. New York, of course.
So the real estate for that.
Real estate.
Okay,
for that.
yeah.
Exactly. So we are investing in the real estate for that, warehouses and distribution centers. The other one we like in the U.S. a lot, from a real estate perspective, is multifamily residential, because the millennial population, so to speak, right, is much more mobile, is much more willing to rent, is much less focused on owning their first home and the second home and so on and so forth. So home ownership, we think, is seeing a stabilization at lower levels than used to be the case in the US in the past. And that has created, again, a very strong tailwind for strong returns from multifamily residential. So we've been one of the most prolific investors in multifamily in the US over the last 3-4 years.
And where are you seeing new opportunities in companies globally?
So, from a private equity perspective, a few years ago, we pivoted to focus much more on business services. Historically, private equity really used to shy away from services businesses because the underlying assets of a services firm are the people, and you don't really want to take on the risk of the people walking away, right? So that used to be the hesitation. But increasingly, we find the business services space, both the upper end of that space, the higher value add space, and I'll give you some examples, as well as the very low end of that space, we feel are attractive mainly because of the fact that A, they are somewhat more immunized from some of the automation trends, driven by robotics and so on and so forth, which are impacting the manufacturing sector. And B, they are also somewhat less susceptible to the other technology-led innovation, which is artificial intelligence, robotics, and so on, right? So we find ourselves having, a clear runway for the next, 5-10 years in these business services sectors. Like, for example, we invested in a business in the United States that provides HVAC, plumbing, maintenance services to residential homeowners. You're not going to find a robot doing that. You're not going to have AI disintermediate that, On the other end, we invested in Alex Partners, which is a high-end, specialist consulting firm. We invested in UTA, which is one of the top 3, talent agencies in the United States and actually globally. These are high-end, very high value-add, people-based firms providing services to businesses or consumers, and we feel that the risk-reward profile in that sector is quite compelling. We've translated that increasingly from the US now to Europe. And we hope to, I told you about the China tech investment that we did, similar theme over there. And as we enter India, we are looking to back there much more of a grassroots consumption-led strategy. Because in India, one of the things that we felt presented an inordinate risk that you don't really want to take on as a private equity investor is the overhang of government policy, regulatory change, et cetera, because that's unpredictable. That's an exogenous risk factor. But the grassroots consumption, story in India, driven by demographics, driven by the fact that there are 450 millennials that are all, either entering the workforce and their, discretionary expenditure consumption is growing. They are going to consume basic services, leisure, entertainment, apparel, that you would expect any millennial to consume. That is growing rapidly, and we think participating in that rapid growth makes a lot of sense in India.
What investments are you staying away from or are at risk, do you think?
So anything that has high regulatory policy-led overhang, we shy away from. That used to be the practice in the past. It's become more of a principle now, and particularly in light of the fact that one of the bigger risks we see at a macro level for the global economy is actually led by anxiety created by intergovernmental tensions and even domestic tensions internally, etc., that governments are having to deal with. So we are steering clear of all sectors that could be affected by
what types of sectors are those?
So, for example, in the U.S., anything that is primary healthcare that is affected by a change in government policy, we would avoid. Second order, third order down, which is servicing the healthcare space and capitalizing on the, again, very strong secular long-term trend of growth in terms of provision of quality healthcare and outcomes, that we love, right? So we kind of want to stay in these domains. We want to stay at least one step removed, just like I described in India. We would prefer not to invest in infrastructure, but we would love to invest in something that is using the infrastructure to produce growth, etc. Same thing in healthcare in the U.S. So these are some examples. Telecoms would be another space in the U.S. in particular that we would shy away from given regulatory overhang.
Do you have one trade in your portfolio that you're really excited about?
We look. You never ask a parent which child you love most, right?
I
So
have a favorite.
You do? I've only got one,
Just
so I love her totally. But in our case, I think the way we look at our portfolio is it's a spectrum of risk reward, right? Our clients are very sophisticated investors, internationally as well as in the Gulf, and we need to be able to give them line of sight and access to a full menu of offerings, right? Where they can pick and choose which particular product or combination of products suits their needs, their risk reward profile. And if you recall the way I described our business, between the absolute return strategies business, which is very focused on special sits, the credit business, which is very focused on current yield, the real estate, which is mostly current yield, a little bit of capital gain, and the private equity, which is all big proportion of it is capital gain. It covers the entire spectrum, right? So we like that positioning. We feel that there is a long-term trend, on the part of investors to capture the liquidity premium and go into private markets. And as a private markets investor focused on alternatives, it's a good place to be.
And before we started, we were talking a little bit about the alternative space right before the financial crisis. Is there anything that you see right now that you're worried about that you think other alternative investors should be worried about?
I'll tell you from our perspective, we think valuation multiples are certainly peakish, right? And frankly, one of the things we've been doing now of late is underwriting a likely contraction in terms of multiples on the way out. So we are 5-year investors, and our view is that whilst we'll have to pay market prices in terms of anything we buy today, when we are looking to sell 5 years down the road, it is fair to expect that levels have normalized, and we'll be selling at normalized multiples as opposed to some of the more elevated, optimistic multiples that we see today. So that's clearly one risk. I think debt levels at the corporates and in terms of real estate are relatively controlled, and in our credit business, we continue to see pretty healthy momentum in the underlying portfolios. So not many yet, right? Not many amber lights flashing. I think the anxiety that we are seeing on the part of corporates now because of the challenges at the intergovernmental level, some of the tensions, etc., that may cause a little bit of caution, and that caution in turn, if it results in a pause in terms of business sentiment or investment, may have a trickle-down second-order effect. But we put all of that into a cyclical slowdown category. We are not in the camp today of underwriting a 2019 recession in the global economy.